Good morning. So today we're going to talk about modern portfolio theory and picking the optimized mathematical allocation based on the asset classes that you want. Now, this man invented modern portfolio theory in the 50s. He wrote a paper on it, and he later won the Nobel Prize. And this led to the proliferation of Vanguard, all these mutual funds, Fidelity, et cetera, et cetera. But as we said before, you can do it yourself. Now, it's up to you if you want a financial planner, but you can do it yourself. And there are free links that we're going to show on the web that will optimize the percent allocation that you have. So what is modern portfolio theory? Here it is, and the seminal graph of this is the efficient frontier. So in previous videos, we've studied standard deviation, and obviously people want an expected return. So we want this to be high and this to be low. So if we wanted the maximum expected return, we'd want this point on the line, which is specific allocation percentage. And if we had a different allocation percentage, we'd have lower return and higher risk. And note, this isn't a linear relationship. You can mess up your portfolio such that you're getting less return for the same standard deviation you would have if you adjusted it. That's why it's bad to start messing around with allocations and changing things. You set the efficient frontier and you're good. As you get older, you might want to lower your standard deviation every year or a couple of years, but it's the opposite. Investing for the future is the opposite of the American way. Work less or work hard to figure out what to do, then don't touch it, or touch it a little as you age, and that's how you get the best result. If you keep playing with it, you're going to end up down here. Okay, so we talked about Harry, we talked about the efficient frontier. So let's get into our Excel. And we talked about standard deviation last time. Okay, and we said we're going to start to get into blending. So here's a 2 allocation example of what happens when you blend depending on your risk tolerance. So I didn't include the 99.85% risk tolerance because that's a 1 in 1,000 year event. So here's a 2 in 100 year event. You want your return no worse than to get $500. How much would you have to invest? To get a 50%, you're gonna one time you have at least half a chance of making $500,000 with this investment per week. Just as an FYI, in the previous videos, we had calculated this out together to be $188 a week, but actually I counted year 1 as year 0, so it was only 19 years. So the actual amount is 168. So okay, so we have 100% stock or 100% bond. So if we wanted 98% probability that we would get $500,000 for that high of certainty, then we need $346 a week, more than double what you would need at 50% probability, and it's also 100% in bonds. If you only wanted 84%, that's one standard deviation. Remember, the standard deviations are the spread between here. Plus or minus 3 is the full certainty, plus or minus 2 is 95%, plus or minus 1 is 67%. But I said before, we don't care if we get tremendous upside. So in here, we cut the 5% in half, and we move this, so we say that there's 97.5% above the negative 2 sigma minus average line, and we round that up to 98%. So this is the 2 sigma line, this is the 1 sigma line. After we do the calculations, this turns out to be 1 sigma. So if we wanted 84%, we'd need $268 a week. And we already talked about the 50%. So it turns out that on these particular certainties, we don't need a diversified portfolio. But when you start to get into multiple asset classes, more than 2, you start to get the effect of the efficient frontier. It's not a straight average. You can't add up standard deviations and create an average like you can with the regular average return. Standard deviations are not so-called linear operators. You have to convert them to variance to take the average, which is to square them. And then there's also a potential covariance. So the math gets really complicated. But to calculate the efficient frontier, I'm going to include a link. There's one PhD mathematician that does it in Excel in about 12 minutes. But like I said in the beginning, we're going to show the link to a website where you can do it for free. Now, even though the blend of stocks doesn't impact these particular certainties, there's a note worth reviewing. So I greened out the lowest investment for these certainties, and we go from stocks at 70%, so bonds would be 30, 40% stock, 60% bonds, 15% stock, 85% bonds. And you see in this particular graph, at 98%, it goes 416, 414, 402, 377, then down to the lowest one at 100% bonds. But here's where the efficient market theory and the very basic building block, Markowitz, is much more complicated. But notice that this one goes down from 301 to 286. It goes up to 300, and then it goes up to 305. So there's a low point in here. It doesn't get as low as 100% stock, but there is some efficient frontier stuff going on down here. And similarly, here goes this one, no. This one just follows the trend, so I shouldn't have highlighted that one in red. But at the 1 sigma one, it does. Now, we had started out with compound interest going year over year, but again, Excel has a cool formula, the FV formula, and we can figure out, you can go look this up, just Google Excel future value formula, and you can figure out how to do this over 20 years. So in the end, summary of this sheet, before we get into the efficient frontier, a summary of this sheet is for a 20-year investment to achieve $500,000, the best way to do it is invest $168 a week for 20 years. If you want higher certainty, then you have to more than double your investment and leave it in bonds. So if this is me and I'm in my early 40s, I want to be right here. Okay, let's take a look at the really cool efficient frontier stuff, which kind of summarizes the investment strategy part of my video series. After this, we're going to talk about different things, like now in June 2022, the market's sort of tanking, bond markets are tanking. So what do you do if you get like a $5,000 bonus? What do? You dollar cost average. So that's another video. Then if you're approaching retirement, what do? If you got lucky and you were in the 50% or worse category, but it turned out brilliant and you made $1 million, how do you withdraw that and never run out of money? So that'll be another video as well. But to conclude our series on how much we would need to get to $500,000 in requirement if we were in our early 40s, this is the website to do this. So let's take a look. This is free. I'll put this in the link, obviously. Now, the percentages are slightly different than we calculated because we went back 100 years. This particular calculator only has data back to 1972. So what is that, 50 years? But that's fine. Because you're just going to follow the modern portfolio theory. You're going to put your assets in these percentages, and you're going to get the best result. 1% difference in your historical yield isn't going to make any difference. So okay, so let's pick our favorite, the stock market. Let's pick Pacific stocks for this example. No, I changed my mind. Let's pick European stocks. Pacific stocks are a little more volatile. And then let's pick some bonds. But let's have fun with it. Let's pick some long-term bonds. They have a little more variability than total bond market, and certainly more variability than the short-term bonds. So I don't know where to start. Let's go 33, 33, 34. So all you do is you pick your asset classes. It has equity, it has international, it has bonds, it has gold and REITs. We talked about that a little bit. And then you put in your allocations, and now it will show you, with modern portfolio theory, the ideal allocation. Plotting standard deviation, which we've studied, and expected return. Now we want the highest return and the lowest standard deviation. So here is the tangent, and here is the optimized portfolio. And it says that we should have 44.65 in US stock market and 55.35 in long-term treasuries. Interestingly, European stocks aren't included in the optimum portfolio. Here's what we put. We put about a third in each one. If we wanted to stay at the standard deviation that our portfolio came up with, remember this is year over year. So if we invested this for 20 years, we'd have to divide by the square root of 20 due to the central limit theorem. But we can do the efficient frontier on a year-by-year basis because it will all normalize out. So if we just readjust it, if we go 67% and 33% with stocks and US long-term treasuries, we're good. It actually, if we take out the European stocks, we're bad. there's actually no place where the European stocks are any good. So let's go back and let's try another one. Let's add Pacific stocks to the mix, and let's add small cap to the mix. Now this one's going to have Pacific stocks, I mentioned earlier, have very high variation. Same with small caps. We talked about that a little bit. So let's see the optimum portfolio here. Now, the provided portfolio is way down on standard deviation with 10% return. So the tangent, we'd want to adjust that 38 small cap, 38 European, and lower the Pacific to get on this tangent line here, which would be the optimum, and the standard deviation would only go from 16.2 to 16.3, but our return would go from about 10 to about 10.4, 10.5. And we can see all these different, with higher standard deviation and somewhat higher return here. So let's do one more example, and you can try this at home. Obviously, let's add REITs to this for fun. So we've got REITs at a third, European stocks at a third, and Pacific stocks at a third. Let's see the best one. So again, we were pretty good. We're pretty close to the optimum portfolio because we're at the tangent of the line. So our expected return is around 8%, and our standard deviation is near the lowest of the graph at about 15.1, 15.2. So stay along this line for the optimum mix and follow the percentages that are listed. This is the optimum. We don't want to be down here, invest 100% in European. Certainly don't want to be down here because we're much more efficient up here. And you can do this for any asset class you want. So this summarizes, we started with how much money do you have to save to get to 500,000? That only works half the time. How do you improve that to 84%, 98%, even some people 99.9%? You have to invest more and more money to do that. So you have to start to allocate. One final thing I guess I can show is Burton McKyle started after he used Markowitz's Nobel Prize, and he wrote the book Random Walk Down Wall Street, which is a great book. And so we're going to ask what he has some allocations based on age. So let's see, maybe I spelled this name wrong. Burton McKyle. Nope. We can figure this out together. We'll go over to images. Here's some different allocations that here's a mid-20s one. Obviously, it's going to be heavy in stock. And he's a leader in this kind of stuff. So again, you can do it yourself. Nice quote by Warren Buffett up there. A random walk down Wall Street, he'd recommend 70% in stocks, 15% in bonds, and real estate investment trusts 10%. And cash. And, you know, I'm not telling you guys to do anything that I didn't do or recommend you guys do anything I didn't do. This is how I invested. So that's that. If you like the video, please click the thumbs up, and looking forward to seeing you guys again sometime in the future. Thank you.